when we talk about the advantages of ETFs in general, the advantages for ETFs really come down to the ability to buy and sell baskets of securities. And you can do that inexpensively and efficiently. I always tell investors, what would you prefer to own? Would you prefer to own a single stock or a basket of stocks? The basket of stocks is going to be less volatile, less risky. And that's ultimately the benefit of exchange-traded funds. Yeah, so the question about how an ETF is structured to follow an index, it's a great question. I get it a lot. And I like to compare that to actively managed mutual funds. So an actively managed mutual fund manager is going to buy and sell the securities or the stocks that they think will outperform the underlying index. A passive ETF manager is going to buy all the stocks in the index. It's going to be the market, more diversified, a little less volatile. Liquidity is important because, by definition, liquidity means it's your ability to get in and out of a security quickly and efficiently at a reasonable price. And that is important. The liquidity of a stock is equal to its trading volume because a stock has a fixed supply. But the liquidity of an ETF is different because there are 3 layers of liquidity. The first layer of liquidity for an ETF is its trading volume, how many times per day that ETF trades. Then there's a second layer of liquidity, which is that there are market makers who are out there posting bids and offers on that ETF. Then there's a third layer of liquidity, and that third layer of liquidity is that you can create new units of an ETF if there's excess demand, or you can redeem units of an ETF if there's excess supply. Am I going to be able to get in and out of an ETF in volatile markets? And the answer to that is yes. Because of those 3 levels of liquidity, for every buyer, there's going to be a seller, and for every seller, there's going to be a buyer. That being said, there are sort of 3 rules of thumb that I always advise investors to go by. Rule number 1 is always use limit orders when you're buying and selling ETFs. The second rule that I really rely on is try to avoid trading ETFs in the first half hour of the day and then the last half hour of the day. That's when the markets are sort of most volatile. And then the third rule of thumb is I always say try to trade ETFs when the underlying stocks themselves are trading. I'm often asked, how does the ETF and the price of the underlying assets stay in sync? Imagine the ETF itself is priced at a premium to the stock. There are going to be investors out there who are going to see that mispricing. They're going to go to the market, they're going to sell the expensive ETF, they're going to take those proceeds and buy the inexpensive stocks, and they're going to pocket the difference. And they will do that until the value of those 2 securities goes back in line. That process is called arbitrage. What should you be looking at when you look at ETFs? Is it the volume of the ETF or the liquidity of the underlying? The answer to that is you really want to look at both. Oftentimes, ETFs that are very mature, they'll trade so much that their bid and offer spread will oftentimes be tighter and they'll be more liquid than the underlying securities themselves.